Hello traders, welcome to the section where we're going to do the installation really quickly because we also already did the dome installation, and obviously I went through that in much more detail. There's really no need for me to go over this again. It's exactly the same process. Go and check the depth of market installation. It's just a different file, so I'm going to put a different file in. But what I've also done in this section, and it's really important, is I've basically done a what I look for when I'm looking for a trade using the footprint section, because what happened is you'll see there's a live trading example. Now at this moment in time, I've only put one trading example, live trading example, and I reviewed it and I realized it's very advanced. And I realized that unless I do a dedicated section where the chart is static, so you know exactly what I'm looking for on a very basic level, clearly spelled out for you, I've realized it's going to be too confusing if you use the live example I've put in. So until I get a chance to put in a live example that is textbook, of course the market's not always textbook, I thought what I'd do is I'll quickly show you the installation, and then I'll quickly show you what I look for, and then in the live example you'll see I discuss it in much more detail. But the type of example I show you in the live example is a bit of a variation, so if you use that to learn, I recognize it might be a little bit confusing. So let me give you more of like the textbook what I'm looking for, and then you'll see in the live example how it's a bit more advanced and how it can vary, and then when I get time I'll put in a bit more of a picture perfect example. So the reason you see depth of market here is because all I've done is I've kept the depth of market. You can get rid of them if you want and just use the footprint. Like I said, in my trading pro course onwards, we're not really gonna look at the depth of market, so let's just minimize those. And in fact, on my futures trading, I don't really look at the depth of market, so you can get rid of it. I've just kept it there for completion's sake, I suppose. I mean, it's there anyway, so thought I'd just leave the decision to you. And then as you can see, you've got here G7FX Pro footprint chart book. So that's the one I want you to load. You've seen the process how to load it into the file, the Sierra chart file, and into which folder. Now what I'm going to do is I might as well just go through this with you quickly because the futures may have rolled since the last time. So I just want to remind you how I'm doing this. And actually it may seem to you that, oh, this process is quite involved and envy, do I have to go through this every time? But don't forget, this is an extreme example because I've put 5 futures contracts in here. Typically for my futures trading, I'm only looking at a couple, and then maybe the currency. So it might be only, I don't really follow the treasury, so that's one less. And then don't forget, all the contracts are 3 months. It's only oil that you need to be updating every month, and if you're not trading oil, that'd be one less. So I won't worry too much about it. It's a fairly straightforward process. But what you basically do is you go into the name column, as we've already gone through. You click find, and then for each one I just go through them one by one. And because you've clicked on treasuries already, it will load it up. So you want the next 3, so June, September, December. And then what I do, a little trick, is I just write it down. So I know I'm looking at June. So ZN is the contract. That's never going to change. So I just know that. What is going to change, the only thing here is the year. The year changes once a year. Come on, it's going to be 20. We all know 20 is 2020. If it's 19, 2019. If it's 21, 2021. So that's easy. The one that sometimes can be hard to remember is it March, June, September? So it's the middle letter, HMU. So I just write down the next 3. So you see as MUZ, right? So I've literally written down MUZ. So you can see it there in the middle. That's really the only thing that's changing, isn't it? Because look, ZN and 20 remain static throughout. So I know for the treasuries, the next 3 are M, U, and Z, which is June, Sep, December. And the thing is, look, I know that the E-mini S&Ps runs every 3 months. I know that the British pound runs every 3 months. I know that the euro runs every 3 months. The only other one I need to check is crude oil, because it's going to be different to MUZ. If I double click on that, so I double clicked on the crude oil contract, click on find. It's under NYMEX, remember? Look, I can see the next three, April, May, June, same concept. CL is always going to be crude oil. 20 is 2020. So yeah, the only thing changing again is the month, isn't it? So here you can see J, K, and M. So I just write that down. J, K, M are the next three. Then what I do is I click cancel that. And don't forget, your codes are going to be slightly different to mine, because as I did in the code clarification video, I believe you just don't have this bit after the 20 in any of them, so that's okay. It's because you've got the delayed data. This is assuming you don't have live data, so don't let that put you off. You just need to obviously make sure that you don't have this bit afterwards, the futures, NYMEX, whatever. So basically all I'll do is I'll just go down and I check, is it MUZ on all of them. So you can see here's H, so I change that. So we're doing this together. ZM and M, so that's M, U, and Z. Now there's not much volume right now because as I'm recording this, the futures market's just opened. That's why you see very little volume, but that's okay. The concept is the same basically. So again, you see I've got H there, so I'll put M. Just changing that middle letter, M, U. This is the best way to, you'll have to learn this at some stage. Because look, ZN, we know that's the Treasury. 20, year 2020. The bit that sometimes get hard to remember is the month. June is always M, SEP, DEC, and anyway, we want to see what the next ones are. So it's MUZ, MUZ. Then for crude oil, remember I wrote it down, JKM. Is that J? Yep, that's J. That's K, yep, and that's M. And then these ones are 3 monthly, aren't they? British pound. So MUZ again. So look, that one changed to M, U, and then Z. And then same here. I've got M, U, and Z. Okay, now normally your charts are going to prompt you anyway to do a futures rollover. But what we can do is we can see ourselves, what's the most liquid contract in each of these? Would you agree? Look, there's nothing trading in September, December in the Treasury. So we know the most liquid contract is ZM M20 right at the top. Unsurprisingly, S&P 500 is the same, June. Crude is the middle one, isn't it? May, look, May's got 3,491. Now, in the daytime, unfortunately, I'm doing this right now when the market's just opened. That will be more like 200,000, and that will be more like, I don't know, 10,000 or whatever. But the point is, it's the most liquid contract. It's got the most number of contracts in it. So it's, at the moment, the May contract. And then again, as we saw before, in the British pound, it's June. There's nothing trading in September or December. And then in the euro, it's June as well. So what I do is, I've got a little trick where I will obviously check on my charts, but you can also check on the window just to make sure. So you can see that we just agreed that for all of them it's June, and June is M, the letter M. So what I'll go down is I'll just go and check that they've all got M, and then crude is the only one that's different. It's K, isn't it? So can you see here it says M20, M20, M, and then crude is K. So I know that's right. And then I'll just keep going down basically. That's M, K, which is what I wanted, isn't it? K. There you go, K, and then M. Then the crude oil futures there is K, M, and then with the footprints, if you see, Again, we've got the correct contracts because it's M, which is June for most of them, MM, K, MM. So they're all actually correct. So if I minimize that, so what I'm going to do now is in the footprint, what you've basically got, you've got all your depth of markets, you've got the same, so you've got exactly what you had in the dome, but now I've given you all the footprints. Okay, now I don't actually use the treasury footprint because it's too thick a market. Look at the Renko that I've got up here, it's 2 ticks, guys. End of the day, this market is just too thick for me to be using the footprint. I don't trade it, so I'm not going to go over it, but what I am going to go over, because we're moving on now, obviously, to the pro course, we're looking more at some of the more orderly markets with good moves in them. We can move on from the treasuries now. The treasuries was just there so we could learn the depth of market stuff and get to grips with order flow because it's a bit slower. We're advanced now. We're moving on. We're moving on to slightly more normal markets in the sense of a decent range that we can actually grab using charts rather than using the depth of market. Because if you try to trade treasuries off a chart, you can drive yourself crazy because it just doesn't have the movement or the range that you're after. So I typically tend to stick to much more meatier markets, but with good order in them. So the S&P 500 and crude oil are generally the two we're going to focus on because I look at those all the time, and they're the most heavily traded futures in the world anyway. Treasuries is obviously very liquid as well, but it tends to have not necessarily as much speculation from across the spectrum. So I just find these markets better, and like I said, you tend to get bigger moves in them, so you can grab more meat out of moves. So basically, that's what it boils down to. So the first one is the E-mini S&P. Let's just go through them one by one. In fact, because the example is on the pound, let's start with the British pound. So if we go to the GBP here. So the first thing is, so essentially that's it. That's the installation covered. I've given you the same 5 footprints, which is the US Treasury, the E-mini S&P, crude oil, British pounds and euros. If you want any others, it's the same thing. You can go to chart. Do you remember how you did with the depth of market? I showed you how you can duplicate chart and then within chart settings and then symbol find, and you can pick any one. If you want to look at something else, that's up to you. Okay, but I'll put those standard as 5. It's custom built, but again, happy for you to use that on any other instrument. It's not just dedicated to those 5 markets. I've just kept those 5 in because they're a nice broad spectrum of thick volume to very thin volume. That's all it is. So the first thing I did promise you guys is I said to you, look, I'm going to explain to you how I come up with this tick number for the Renko. So what I do is, basically, what are we doing? We're looking for turning points, aren't we? So what I do is I'll scroll along and I'll look for decent areas where the market's had big turns. Now I want that to be nice and smooth, don't I? Do you remember I said the whole point of us using the Renko is I don't want 100 candles or 50 candles or 10 candles, which is what you get when you use minute-based chart, because what the candle will keep forming regardless. I want as much information in one candle as possible so I can really see the turn, and that will become apparent. So I can see trapped buyers and sellers easily because they'll all be contained within one bucket. So what I do is I look for turns, but what I've found over time as well is approximately being able to see 1 to 1.5 hours is really key. Seems to be a good fit. So 60 to 90 minutes. So let me write that down. You can make a note of it. Again, use your experience, watch it yourself. But if you're asking me to give you what I look for, it's about 60 to 90 minutes. I find that a good frame of reference for us to look for what? People to get trapped and then have to bail out, and we can obviously position ourselves. As you're going to see in the live example that I've already put for you in the pound, and I'm going to try and get better examples because that one was very advanced, as I said. So as you can see here at the bottom, it's about what, 4 p.m. to about 5:30 there, so it's about an hour and a half, and you've got a nice turn. So at the moment in the pound I'm using the 5-tick Renko, which is what I mentioned to you, I think, in the examples I've been doing. So sometimes during the year that will change, but I'm going to give you a little head start here. You'll notice when I do the live example, I do mention in there that actually, you know, maybe, and in fact not even maybe, I'm going to give you some alternatives to using the footprint in the future, especially for FX, because the volume's quite thin. So you may be able to get away with that, but that'll become clearer when I give my whole spiel in the next section. For now, we're just concentrating on how we pick the tick number for our Renko bars. Because look, let's do it together. Let's say you go to studies, sorry, not studies, what am I doing? Settings, chart settings, and we change this to 4, right? Can you see you've suddenly got quite a few bars here, right? And then look at the time period. You've gone from about 10 past 4 to 4:44. It's just too much info. Look what happens here. Can you see basically what's happening is in this area, look, it's not going to be perfect every time, but ideally you want that to be bunched up together, because what's really happened there? Nothing. It's just sideways movement. Same in these two. So as you saw with the 5, it was quite nice because it brought all of that, it allowed it to be cumulative. We discussed this already many times. So to me, 5 is a good pick. There's nothing wrong with going with 4, but it's just more info. Why do you want more info? The same info, sorry, on more candles. Doesn't make sense to me to do that. So if we go back to chart settings, so instead of 4 this time, I'm going to go to the other extreme. Let's go for 6. And can you see, guys, what's happened? Too much information. By the time I get in, the market's moved. Okay, so 6, you can see, is not well calibrated to this environment either. So that's all I'm doing. I'm looking for it to be a smooth turn. And I'll typically do that once a month or so, or when it becomes obvious to me that it's not calibrated well. But usually my calibrations will last for several months at a time, so that's good news for you. So that's how I'm picking my calibrations. You can go and play with them, but the way I've left them is for the current environment. You may obviously be doing this course much more in the future, maybe a year or two after I've created this, in which case your calibrations may be very different. I'll try to keep the template as up to date as possible, but obviously that may not always be practical for me to do. But so that's what I've done with the tick. Hope that becomes I hope that's very clear to you, and I'll just show you, you know, what I've used for euro. I've used 4-tick using, and I'm not going to go through all of them, I'll let you do this in your own time. I've put 4-tick for euro because I thought that worked pretty well. Crude oil, I've got 6-tick, and then S&P, I like the 4-tick Renko. Can you see how smooth the turn is? You don't get much bunching up of data here, if that makes sense. You just don't see it, you know. Can you see all the turns? They're really nicely calibrated. There's loads of examples. I remember when I was trying to calibrate this is what I'm looking for. Can you see it? The turns tend to happen within as fewer candles as possible, because that means they're accumulating all the trapped buyers or sellers. So I hope that makes sense. That's your footprint. Enjoy playing around with it. I'm going to see you in a sec and we'll discuss exactly what I look for. Okay guys, so what I've done is I've moved and I'm going to use S&P futures for this. So what will happen, and you'll notice this when you go to the live trade example, that's the pound. Now I may have updated it since, but as it stands, I showed a really good example in the pound, and it's because it showed so many variations of what can happen. It wasn't a picture perfect example. Majority of the time you're going to see this type of order flow action that you're looking for, but that example just had everything. But I realized when I was reviewing it that unless I did a dedicated section where we're just going to talk here, not for too long, maybe 10, 15, 20 minutes, where I'm just going to show you exactly what I'm looking for on a static chart. When I go to do the live example, there's just too much going on. I've realized that now. So I've actually backtracked a bit and I've added this bit in into the installation section, where we're going to actually look at exactly what I look for in a textbook example. And then what you're going to see, it's really good actually, you'll see in the pound trading live example how it can vary. You can get slight variations. Okay, so what I'm going to do is, because actually it's worked out well, because I've already put in the pound live example where I was trading live pound yen and using pound dollar futures, I'm going to refer to that a little bit just so it makes more sense when you go and do that example. But I think the best way to think of this is, let's say you've got some contextual level. So you see in my Discord, or it doesn't matter if it's in my Discord, later on I'm going to show you how to find your own contextual levels to some extent. But let's say it was this area, right? This area here. That's your area of interest. You know, and I'll just get rid of this now because we don't need it. Let's say you're here at 9 a.m. and you've seen me do this all the time. I'll have contextual levels, especially in FX, that I put in Discord. Futures, I do it as well in terms of the E-mini, S&P and crude oil, but just don't want to confuse it too much because it's essentially, it's the same thing. I'm looking for levels where I know I'm going to be trading later. So what am I typically looking to do? If I'm here at 9 a.m, it could be either that I have a contextual level up here and I'm looking to fade that level, and it can be a continuation or it can be mean reversion back into value. But in this particular case, just because this is what I did with the pound, I'm looking to do the same thing but at the other extreme. So the market, I'm looking for the market to sell off and then I'm looking to fade it. Same thing applies the other way. You know, if I was looking for the market to rally and buyers to get trapped, here I'm looking for sellers to get trapped. So number one question you've got to ask yourself is, what am I looking for? What exactly is it? You need to know in the morning, am I looking for buyers to get trapped or sellers to get trapped? So if the market levels, contextual levels that you're looking to fade are below you, you're looking for sellers to get trapped, right? If you're looking for the other way, which is the market levels are above you, you're looking for buyers to get trapped. Okay, pretty straightforward so far. So if we're looking for sellers to get trapped, what does that mean exactly? It means there has to be heavy selling, right? Would you agree the more selling there is, the more sellers that are getting trapped, right? The more people, if you're selling and the market goes against you, what do you have to do? Buy. What direction am I going to be taking? A buy. So the more people that sell, would you agree, the more people eventually that have to buy the market? So that's why I want this to be incredibly aggressive. And this was part of the problem when I show you the pound example, because of coronavirus, etc. It was, I kept saying in that pound example, you'll notice it because I hadn't done this bit yet, and I kept saying, look guys, normally you want it to be incredibly aggressive, the selling, and I just wasn't getting it, but I still got in the trade for a bit more advanced reasons. This is a perfect example, when I was talking in the live example of saying you want aggression, of heavy aggression. So what exactly am I looking for? So number one is, we've said, right, trapped traders. So in fact, if anything, it's always going to be trapped traders. Okay, so how am I, basically, I guess what I'm getting to is, how do we define trapped traders? Well, it's heavy negative delta, isn't it? Because remember what delta is? it is what? Buyers minus sellers. So if it's very negative, there's more sellers. So that's what we said we were looking for. So essentially what I want to see is heavy negative delta. You can see it there. You see it? Minus 415, guys. Minus 592. That means, look at, you can just visualize it. Now, the first things I'll look for, I'll be honest with you, is I'll look at these delta columns. Can you see the difference between so you can see these are aggressive selling. Look at the delta percentages here. 72%. And remember what delta percentage is. If you don't, go back and remind yourself. It's just the difference in the percentage as a total of buyers versus sellers. If that's confusing, go back and remember the formula, the ratio. But can you see the difference in these candles versus, look at these, green, green, green. So visually, I first like to see a lot of red. I like to see red, heavy, heavy red. So I guess you could call it, and I refer to this in the live pound example, but it will make more sense here. So remember me saying it here. I want to see concentrations of, and you can make notes of this, but concentrations of sellers. And you can use this interchangeably with buyers if obviously you're fading levels at the top. This is for obviously when you're fading a market that's moving down. Because again, to remind you, sorry to labor the point, because obviously some of you will get this easily, some of you won't. But the more sellers you have, the more sellers that need to bail when what? The market starts going against them. They're going to be crapping their pants, going, oh my God, it's gone out, boom. They're going to bail, puke, get out of the market. They're trapped. You hear me talk about the Instagram retail bus. And I explain this in the live example, so I'm not going to say it here, but there's a reason why it's institutions that are trading on behalf of retail, because retail brokers essentially are going in, getting liquidity pools in through the institutional market. So even though it's institutions transacting, it's actually on behalf of retail. So it is generally, these will be retailers who are, you know, getting FOMO or wanting to play short breakouts, and we're obviously taking advantage of that. So first thing is, should make sense to you. I'm looking for heavy concentrations of sellers coming into my area of interest. Okay, so can you see it here? Look, heavy concentrations here. Selling, selling, selling. And then I can check here on the table as well. It's clear. Delta, minus 561, minus 415, minus 592, minus... This is just a beautiful textbook example of sellers really getting aggressive. So concentration of sellers, and don't forget these are market orders, actual transactions. So that's point number one. And then I'm looking for delta bar imbalances. So individually within here, can you see the imbalances? Now ideally I want to see them coming right into this area, the interest area. Can you see that, guys? 41 people hit market orders, not a single person bought. Serious aggression, isn't it? 57 contracts were sold, not a single contract was bought. 180. Basically, we're looking for a selling frenzy, because what these guys, they're getting trapped, right? It's basically absorption. That's what it is. This is why I wanted you to spend 1, 2, 3 months on the depth of market. So when I say absorption, yeah, easy peasy. I know what absorption is. It's market orders hitting a level but not being able to get through. They're getting trapped. It's exactly what you're seeing here. Look, huge numbers of market orders but unable to push the market down. Absorption. So basically, you could say concentrations of sellers to imbalances, basically diagonal imbalances. Spelling's terrible on diagonal, but anyway. So you're looking for diagonal imbalances, 189 to 4. You see, it's a selling frenzy, guys. Not a single person's buying. They're all getting trapped. This is beautiful. This is exactly what I want to see. And then finally, so we said there's three things, sorry. concentrations of sellers, which is reflected in the delta, right? You can see the selling coming in, and then nice, huge imbalances. Big, heavy selling coming right into the level, because we know as soon as we get above this, this market's going to pop, because these guys have trapped themselves, okay? And then number 3 is, I actually called it table info in the live example, but it is essentially, it's exactly that actually, table info. Now what do I mean by that? Well, the delta essentially reflects nicely what's going on in the whole candle. And I talked about nice concentrations of selling, because you can, okay, there's selling here, but look at this, guys, minus 455, minus 189. So that's also concentrations of sellers. So within here, so really the only difference between seeing big selling here, look, minus 455, is this number delta here represents the entire candle. This is just a nice representation showing us there's a concentration of heavy selling at one particular price within the candle. Let me show you what I mean by that, because you may get a little bit confused. Would you agree? Look at a candle like this. Can you see any concentrations of sellers? No, they're spread out, aren't they? Look, there's a bit of buying here, there's a bit of selling there, there's some stuff going on all over. Look at this concentration of selling. Look at this concentration of selling. Look at this concentration of buying. Right? Look at this though. It's fairly even, fairly even, fairly even. Can you see? No wonder you're getting this type of action. Then look at this aggression. You're getting concentrations, concentrations, concentrations. So when I was, because there was so much going on in that live pound example, I realized that it wasn't explaining it very well. This is what I'm talking about when I say concentrations of sellers. It's on, and you can make a note of this, individual bars within the whole thing. I want them to be sticking out like this nicely, where it's really showing me that sellers are getting trapped. And then secondly is, so I've put here individual versus whole. Okay, so what do I mean by the whole candle? I just mean this delta, guys, because remember what this delta measures? The sum of the whole selling versus the whole buying in the whole candle. So don't forget, sellers are getting trapped not only at individual levels, but at the end of the day, guys, market isn't perfect. You know, everyone isn't selling typically at the same level. They're going to be selling throughout. Are the sellers getting trapped throughout the whole candle? Let me check the delta, which reflects imbalance for the whole candle. Yes, they are. Minus 592, strong imbalance. So that's number 1, concentration of sellers. Number 2 was the diagonal imbalance, which we're seeing as well, which just really adds weight to the fact that horizontal imbalance, diagonal imbalance, we're seeing aggressive selling. So we're seeing that, yep. And then table info. Now, I'm not going to go through it here again because of obviously time, and I've went through it in quite a lot of detail with the table. I'll end up talking for an hour, but do you remember what I said to you about delta change is nice to see, because we've basically seen ourselves go from minus 415 to minus 592. So not only are we selling, we're getting more aggressive. Okay, then look, I wouldn't worry about this 234, because we're so aggressive. For that to be negative would have to be ridiculously aggressive. As it is, it's good enough because it's still negative here. So you've got to think about the context of this delta change. Are we delta changing here? Is this number versus? So if this candle was aggressive buying and then I saw this as positive, obviously that's different to this being very aggressive selling. And then the next candle, I want it to be about equal or around there or thereabouts. So I'm not too worried about this positive change in delta. Look, it's just a little mathematical nuance. Basically, this is so negative. For this number to be negative, this minus 358 would have to be at like minus 700. Guys, you know, that's just not going to happen. The sellers have shown us quite clearly that they're getting aggressive. The next thing was the max delta. Do you remember I explained this to you? We want, if we're going down, we obviously don't want max delta to be very high. We don't want the buyers to have ever been in control at any point in this candle. Is it low? Guys, it didn't even go positive once. Didn't even go positive once. Huge aggression to the sell side. And then our minimum delta, minus 358, minus 599, which is almost where we ended up. Guys, this is about as imbalanced on the sell side as you're going to get, as trapped as traders you're going to get. And then the delta percentage, remember I said you want below 25%. So you'll see when I do the live pound example, we never quite get there because the market just has been very thin in the pound recently. And I talk about this a lot. That's why I want to show you what I look for in a textbook example. So obviously I want to see sellers as a percentage of buying and selling to be much more negative. So basically across the board, you're seeing everything you want. So you can just go through these as you're actually going through them. So it's concentrations of sellers, individual versus the whole candle, imbalances, diagonal, and then 3 table info. All right. So I hope that helps, guys. Because I do talk about this a lot in the live pound example, as I said, and I wasn't quite able to. I realized it was too advanced, the example, in terms of there was too much going on. I don't want to take it out because for the reasons I mentioned when I was actually doing it, which is I don't want to show you textbook examples only. It's not fair because the market isn't always as perfect as this. A lot of the times it is, but when it isn't, I want you to be prepared for it. So I'm going to keep that complicated example in, but I'm going to take it out. Sorry, not take it out. I'm going to put some textbook examples in later over the next few weeks as I get a chance. But this will give you a chance just to see what I'm looking for in a perfect scenario. Okay, so really when it comes to the buying side, it's fairly simple. I'm only looking for one thing. So when we're getting trapped traders, guys, I'm always keeping an eye on the concentrations of individuals. Why is that? Because when it comes to entry, I need pinpoint accuracy, don't I? How do I find that pinpoint accuracy? I'm not going to find it if I know based on the table. I could say, look, in theory, oh yeah, this whole candle has got aggressive selling. Oh, this whole candle has got aggressive selling. Yeah, that's great. Guys, but if I wait for this whole area to break, I'm going to be like getting in the trades after 20, 30 pips. Because don't forget, these are Renko candles. They represent quite a decent chunk. So I'm looking for particular individual price levels, micro, to help me get in. Okay, so concentration of sellers. So would you agree in this candle? Where's all the trap sellers, guys? There you go. Look. Guys, it's as clear as anything. That's where the concentration is. In here, where is the concentration? It's clear, isn't it? See it? Here, it's there. So that's what I'm looking for in terms of my entry. And actually, as you'll see in the pound dollar example, remember this. I actually love these areas too, and I like to just put in a little line because what will happen is the market loves, algos love to test this, then they'll pop. Because these sellers, okay, so let me take a step back here. So we've said here, trap traders, that's what we're looking for. Entry. What am I looking for? One reference point. Okay, and that's going to be this. Okay, so we talked about it, individual levels. Guys, so what I'll do is I'll mark this level out. Right? What do you think is going to happen when the market starts to go above these sellers? Guys, they are going to bail, right? They realize they're the last man standing. They've been absorbed. They've got all this selling behind them. This is turning around. They're getting very, very nervous. Okay? Why do you think it's no coincidence that the aggressive buying was virtually, it won't always be as perfect as this, but generally you'll see it like here or here. These buying are these sellers. Can you see? It's the similar type of level. Basically, they're bailing out fast, and you're seeing huge imbalances the other way now. Guys, you cannot deny that is people bailing at this level. That's why this level is so crucial. So I'll look at this level, I'll have it marked. Once we've got trapped into this zone, guys, I don't care about this area, I want it to come and test the zone. Then I will look for basically, sorry, let me just get rid of this, imbalances or any sort of aggressive buying coming the other way. So one is reference, two is balances, aggression, other way. See, and because there was so much going on in that live pound example, I don't think I explained it as well as I could have. But that's what I'm looking for. This market to move above the last concentration of trap sellers, because I know as soon as we get above here, guys, this is going to pop. Now, why would it pop? Because one, trap sellers are exiting, but two, ideally, institutions are piggybacking off this. Okay, so everyone is going to be watching this. Algorithms, institutions, they're going to be aware of this. And as soon as this happens, they're going to exit. They're going to enter on the other side. Why? To cause pain. Because think about it, there's sellers trapped here, there's sellers trapped here, there's sellers trapped here. Just because it moves up, they're not all exiting at the same time, are they? Look how many sellers, guys. Minus 592, minus 358. Thousands of contracts short here. Just because it moves up, say to here, only 25, 30, 40% may have exited. There's still 60% left. Think about it. You've got to put yourself in their shoes. Let's say, when you first got into trading and, you're like, oh, FOMO, yeah, I want to trade the breakout. You were probably one of these people who'd sold here. As it went against you 10 pips or whatever, some people would be bailing, right? But would you agree? Some people would wait 20 pips, 30 pips, and then they start sweating. That's what institutions are doing, is they're causing max pain. You'll hear this a lot. It's called max pain. It's called pain points, thresholds. It's these type of areas. That's what it is. Basically, what institutions are doing is they're pushing it. Why? Because they know as it goes more and more, these people that are left are going to be sweating until they're all flushed out. So that's what they're doing. They're causing them pain. So that's why you get institutions pushing, and that's why you don't get a small pop. You get this big pop. Now, what I want you to know is that in the pound dollar example, the live example I give, I'm going to explain it here because I realized I didn't get the chance to explain it as well as I would have wanted to. We actually get the market coming back into, and it wasn't an area of interest, it was more just an area where I felt there were trap traders. But this is going to help you understand that much better. We see the market coming back. Okay, so what it is you've got to realize the market loves to leave orders. So hedge funds, whoever, it could be real money, it could be central bank, it could be whoever. They'll be leaving orders here, okay, for the banks to fill. So they'll leave orders. Obviously, these are all the bank's customers. They'll be leaving orders here. The bank want to go and fill them, so they'll typically employ algos to push the market back into these areas, and you'll see it so much. Half the time it will go, but half the time it will come back. And what actually happens is, you hear this thing about demand and supply. It's all nonsense, guys. It's not demand and supply. What it is trapped traders exiting at break even. So they're relieved, they're breathing a sigh of relief. And that is what happens when the market comes back here. You'll typically get very, very, very strong support in these areas where there's trap traders. So think about it. If you've shorted here, put yourself in their shoes. How many times has the market gone against you? Say 10, 20. This isn't FX, it's the E-minis, but it doesn't matter. It could be anything. Market goes against you, start sweating. You think, oh my God, 20 pips down, please. And then you start praying, don't you? Like, look, I'll never do this again. If you just come back to zero, please. Guys, it happens to more people than you think. Every single day I see it. The market will come back into this area. These guys that got trapped, they'll see their P&L on their screen go back from negative whatever to zero, and they'll just be like, thank you. And then do what? What do they need to do to exit here? Buy. So that's why you'll see the market come back, test this area, and then boom, you'll see trap people exiting again. So you'll see aggression like this, but off here. So that's all I want you to know is in these areas where we're getting trapped traders. So let's say that's trapped, sellers or traders, yeah. You won't always get the move like this. This is a nice one because you got the pop above the reference point. Do you remember I said I look for entry above the reference here? You got the pop. But it won't always happen like that. What they'll do is they'll come back a second time. But I just want you to know what they're doing here. There's plenty, usually there'll be orders here, and it will act as support because these people will get out break even. There's actually a second thing, and it's actually quite interesting. These orders may also be some trapped institutions or whoever that is. And don't forget, the market is a vacuum for orders, and obviously banks are making money filling orders. So a lot of times the banks will also want to fill, if they're large enough, if there's enough people trapped here, the banks will want to fill those buy orders. Because think about it, if these guys want to get out break even, they might have left what? Orders in the market to do what? Buy. So bids essentially, right? They would have left bids. Think of your depth of market. They would have left bids here, guys. Banks will know there's bids there or whatever, or client orders left with the banking desk, the institutional banking desk, and they want to fill them. So they'll just come back and they'll fill them. So you'll see it a lot. So don't be worried if this comes back. Expect it, because you've got your point of reference. That's why I love drawing in these little references, because when the market comes back, I don't worry. In fact, I use it as an opportunity to add, especially if I see it pop by a little bit and then it pops up again. Then I know that's a very, very good sign that the market's going to go up. So I hope that was really helpful. This is a lot cleaner because in the real life example I show you in the pound, it does get a little bit messy, and I just wanted to show you, in an ideal world what I'm looking for. So that's how we get trapped. Entry is really simple. It's looking for the last bunch of individual sellers, last concentration, guys, in this candle, and then I'm looking for the market to just rip up above them because I know they're exiting. It's the first 10, 20, 30% of trap traders exiting. That's why you'll see this aggression coming in, as we already discussed, and you see it there as well, which I've covered up. Then typically, don't forget, we may come back and test it because there'll be orders to get out break even. Won't always happen, but sometimes it does. So you can use that. If you've missed the first move, use that as an opportunity to get in. And then you'll typically see imbalances and aggression. You see what happens on the way down happen on the way up. So you can really see it here. It starts to kick in where you see, some serious. Well, you see essentially the concentration of sellers turn into concentration of buyers. You really see it here. Then you see it here. You don't necessarily. You see imbalances as well. You don't necessarily see the table info. So, okay, you see nice aggressive moves there, but this is fairly balanced, isn't it? It's only 58, fairly balanced there, and then that's fairly balanced as well. The reason that's happening is because there's a bit of a battle going on between buyers and sellers in that. So that candle is probably representative of a bit of a candle. That's a little bit more advanced. I know this because the candle is longer. Look at the size of that candle. It's long, isn't it? Compared to that one. And that's typical of a reversal Renko where a battle's taken place. A little bit more advanced. And we can discuss that in the future once you've got familiar with whatever. So I hope this helps. Go through this a few times, make notes on this, because when I do the live example in the pound, I think this is going to help you a lot. All right, guys, so that's the footprint section. Any questions, let me know. See you later.